On this morning I went to a meeting that a real estate company called MedicX had to some of their London properties, and we think it's a very interesting, pretty low risk, high dividend yielding company. What do? Firstly, they actually are taking money off equity investors at the current share prices. So they've made 3 fundraisers in the past 4 months. They raised 400 grand about a couple of weeks ago at the current share price in the market, 4 million in May, again at the share price at the time in the market, and 37 million in February. That shows that somebody's keen on the business, and we can understand why. What they invest in is medical properties, effectively doctor surgeries, very small sort of polyclinics, you could see it, on average about £4 or £5 million a time, and they're buying these on yields of just under 6%. The great thing is 2 points. Firstly, these are on 20-year leases, upward only. Secondly, they're buying them on about 5.9% yield. They're funding it at 4 and a bit% cost of interest. So they're getting cash in right at the front start of the lease, and that obviously increases as the rents go up. The final point that's really interesting about these guys is that they are buying a fair few properties in London, and the rent for London medical properties is higher than it is in the provinces, but not as high as we think it should be. So we think that their specific property angle towards London is really going to stand them in good stead in the long term. So in summary, this 200 million market cap company is growing in terms of its business. It's having money given to it by equity holders wanting to invest more, and it is able to spend money on really good cash flow positive from day one, with 20-year visibility of the rents increasing and 20-year long funding. There's no other property company sector that's achieving this. There are other companies in this sector which we like, but MedicX was the one that we saw today, and a really good set of assets they've got.